Welcome, everyone. I have to say it's a very auspicious day for the markets with the ceasefire news. It's very good news at face value, and already we've got some of the big holdings in our global portfolios up around 6% this morning. Allianz Technology, the biggest holding, I think, is up 6% to new highs. So we're not quite sure what all the facts are. There's a lot, I'm sure, going on behind the scenes that nobody's aware of. In fact, we're not even sure really who the US is negotiating with. But as things stand, at face value, with the demands, conditions that the Iran regime has requested in order for the ceasefire to occur, it would amount to a very severe loss for the US. And just for instance, the conflict began with the intended objective of regime change, that change to disabling nuclear and missile facilities, and now it's opening the Strait of Hormuz, and Iran is insisting on a massive tax amounting to about $80 billion per year. So none of this was the case before the conflict began. We can understand why President Trump wants to end it. He's got the midterm elections coming up later on this year, and he needs to focus on shoring up the electoral support. But of course, the electorate in the States, there's only one thing that they dislike more than war, and that's when they lose a war. So we've got a ceasefire for a couple of weeks, but it's definitely not a certainty that the ceasefire will remain. I think we're obviously very happy at the moment with the markets, with peace in the air, and let's hope it does end up in a diplomatic ending which suits all parties, but I would say it's a little bit unlikely. Anyway, just a quick comment on why the markets have been so resilient up till now. And that is really because going into the conflict, the world economy was actually accelerating. And amidst that accelerating global growth, we also had considerable monetary and fiscal stimulus from a huge investment boom in data centers in the US and the supply of AI infrastructure materials from various countries around the world, predominantly in the Far East. So because of all of that, the markets have been surprisingly resilient during the conflict of the last 4 to 5 weeks. So the schedule in my presentation this morning, we're going to talk a little bit the geopolitical analysis and then the economic analysis. And of course, 95% of the presentation revolves around the Iran conflict. And even the other items, even if they're not directly related, they are indirectly related. And then we're going to turn to a spotlight on the tech sector, which is looking very cheap at the moment, surprisingly, even though the NASDAQ hasn't dropped that much. And then we're going to move towards Fed policy. A cornered Iranian regime could escalate unpredictably. Attacks on Western targets, we know their missiles have the range for it. Comprehensive destruction of Gulf oil infrastructure, and even resorting to weapons of mass destruction. We know they don't have nuclear capability, but maybe they do have a crude nuclear device. So this is an unlikely scenario, but not impossible, and certainly unlikely over the next 2 weeks, at least. The Trump administration is clearly ready for a deal. Trump surely cannot let Iran gain sovereignty over the strait or emerge in a position to dominate the GCC. A real alternative is Iran war scorched earth, and that's what we narrowly avoided last night. This would be a more intense and damaging war lasting several months, with sustained triple-digit oil prices and regional spread. Brent at $120 to $140 per barrel for months on end. The narrative shifts from inflation shock to stagflation to outright global recession. And that has been avoided from now. And that's a fantastic thing for the markets, which we can see currently in the pricing of equities and bonds. So let's move to the economic impact. We mentioned this before, but oil prices are only slightly above their post-1970s average, even at yesterday's levels when adjusted for inflation. And most major economies, including the US, have become much more resilient to higher oil prices. And why is that? It's because they are much less dependent on energy. So last year, statistically, the global oil consumption per unit of real GDP was just 35% of its level in the 1970s. And as a result, the global economy has become more resilient to oil shocks. A spike in oil prices to $125 per barrel that persisted over the course of a year would imply that global crude oil spending would rise to nearly 4% of global GDP, and that would only be moderately above the long-term average. What is needed for a global recession? A price surge to $200 per barrel would be needed, and that would be equivalent to more than 6% of global GDP. In the past, that has triggered a global recession. So we've been nowhere near that up till now. So these are remarks from MRB in this next piece. This is what they've got to say. The global economy had substantial positive momentum coming into the year, which combined with supportive fiscal and monetary policies is providing resilience against the negative shock of the war on energy and other supplies and prices. What does MRB feel? The ECB will have learned the lessons of its ill-fated rate hikes in 2008 and 2011 amidst pronounced increases in oil prices, with its economy on the precipice of a recession. And the BOE, the Bank of England and the Bank of Canada are also likely to err on the side of protecting economic growth, even at the risk of higher near-term inflation. And then, moving on to Alpine Macro, quoting from their global strategy report written on the 2nd of April, 2026. Although financial markets are highly volatile, the Iranian war has inflicted limited damage on global growth and earnings per share. Investors should buy the dip rather than sell the rip. Global exports are accelerating. China's export growth has rebounded to 40% year on year. And if we look at the US, the Consumer Confidence Index, the University of Michigan Consumer Confidence Index, while down from early 2025, has stabilized and improved in March. The March US jobless claims data suggests that the US labor market is slowly improving, not deteriorating. And finally, Fed Chair Powell has made it clear that the Fed has no plan to raise interest rates to deal with rising oil prices. So according to Alpine Macro, looking forward, our bet is that disinflation could soon resume. With nominal wage growth slowing and productivity accelerating, inflation pressures will likely ease, even in the face of a sharp but temporary rise in oil prices. And a couple of additional points, although US stock prices remain 3 or 4% below pre-war highs, equity multiples have declined by 15%. And this is largely due to rising interest rate expectations across the curve. We maintain a bullish view on US Treasury bonds, believe 10-year dated yields will return to pre-war levels of 4 to 4.1%. It may be surprising, but valuations for the tech adjacent sectors, so that's consumer discretionary and communications, have significantly improved. The aggregate tech sector's forward P ratio is corrected to 22x from a peak of 31x late last year. In the process, the valuation premium of the sector has shrunk from roughly 35% to less than 10%. So that's the premium over the S&P 500. How has this happened? Forward earnings estimates sharply, and also the NASDAQ sector or the NASDAQ market has corrected by far more than the S&P 500. So since the tech boom that began in 2022, whenever there's been a sharp decline in the premium, that's normally a harbinger of a sharp rally in that sector. What does it mean? And here we're turning to Capital Economics. They've been very strongly bullish towards the AI sector, and that has not changed. The conflict has not darkened the outlook for tech earnings. We continue to think stocks in the US, China, Korea, Taiwan, and Japan are best set to benefit from AI enthusiasm. This is based on their exposures to AI industries. The FOMC left the policy rate unchanged in a range of 3.5 to 3.75%, and the median FOMC participant continues to forecast one rate cut this year and one next year. What else did they do? Significantly, they made changes to the higher long-run growth rate for the economy. That's the potential growth rate for the economy, which does not cause inflation to occur. So the longer-run growth rate had been 1.8%, and it increased it to 2%, which is significant. And Jay Powell attributed this increase to recent gains in labor productivity growth. He also said that even though his term will end in May, he would continue to serve as temporary chair until Kevin Walsh is confirmed in the role. He also said that he would continue to serve on the Fed board as a governor beyond May, at least until the ongoing investigation from the Department of Justice is over. So all of this reduces Federal Reserve policy uncertainty, which is good for the markets.
Hi, Nick. Flip, thank you for such a positive update. Glad to hear more optimism coming out of the markets, especially what we've been through so far this year. Locally, we are still seeing green shoots, and we're confident that can continue at a moderate pace going forward. The same macro environment has continued to improve on several key fronts, and we think the investment backdrop is actually becoming more favorable, even as some external risks, like what's been taking place in the Middle East, remain elevated, or have been elevated, let's say. So today we'll cover three areas. Firstly, we'll look at the macro data. So interest rates, growth, inflation, and business confidence in SA. Then we'll move on and check how the market's been doing since the start of the year. And then finally, we'll finish off with how the OAM portfolios have performed for the first quarter, as well as what we expect going forward. Inflation continues to behave extremely well, or at least for now. And even with some bumps in the road coming up, the BER 2026 Q1 survey showed that average next year inflation expectations for three professional groups dropped to 3.6%. Household inflations, on the other hand, rose slightly. Looking at the hard data though, CPI for Feb 2026 came in at 3% year on year, which is right in the middle of the Reserve Bank's 2 to 4% target band. Important to note though is that medical aid contributions were not fully captured in the CPI stat, as some schemes have delayed their tariff adjustments. PPI came in even softer at 1.8% in Feb compared to 2.2% in Jan, suggesting that factory gate price pressures remain well contained. We do, however, expect to see this pattern shift as significant fuel price increases add upward pressure going forward. And as Standard Bank noted in their latest research, the rand and higher oil prices remain key risks to the inflation outlook at this stage. They do forecast CPI at 3.6% for 2026 and then falling to 3.2% for 2027 and 2028. The SARB rate decision. Big headline that everyone was hoping to see 2 weeks ago was that the Reserve Bank's decision would be to cut the repo rate by a further 25 basis points. Internally, it looked like we were on our way there. And with inflation behaving for months now, you'd be right to think we were en route to taking another step down the interest rate graph you can see on the screen. That is in a warless world. Unfortunately, the month of March had other plans. The last 6 weeks were action-packed, to say the least. Tension, uncertainty, conflicting information, constant noise in the market, and of course, multiple theories of what was going to happen next. That all added to a bit of extra volatility in global and local markets. As you guys have probably noticed, the oil price surged from mid-60 range to over $100 a barrel. And since we are net importers of oil, our fuel prices were on their way up as well. Since fuel prices are an important part of the CPI basket, inflation was likely to be impacted. That being said, Treasury did decide to temporarily reduce the fuel levy, which should soften the blow for the near term. Going into their meeting in late March, that did leave the Reserve Bank and Governor Kanyako in a bit of a tough spot. Although the inflation stat is currently at 3%, in other words, hitting the target CPI right on the head, the SARB is prepping for the inflationary impact that higher oil prices could possibly have on the index. So, what did they do? They prioritized inflation expectations and currency stability over short-term growth support. They kept rates unchanged for the time being, leaving the repo rate at 6.75% and prime lending rate at 10.25%. In terms of the vote split though, there was none. All 6 members voted to keep rates the same. And although that was unfavorable, it wasn't necessarily unexpected. I think it's worth acknowledging. Turning to growth, GDP for Q4 2025 came in at a positive 0.4% quarter on quarter. That's the 5th consecutive quarter of expansion. With 2025 total growth landing at 1.1%, that's more than double the growth we saw in 2024. Now, let's put that into context. We came off a low base that included significant power supply disruption and infrastructure bottlenecks. So steady positive growth, even at just a modest pace, is a meaningful improvement. The direction matters more than the absolute number right now. And with load shedding largely resolved, lower interest rates starting to filter through, and business confidence recovering, the consensus expectation is for growth to accelerate modestly throughout the rest of the year. Rounding out the macro data, the BER Business Confidence Index for the first quarter hit 47 points. That's an 11-year high once you exclude the pandemic era distortion from the COVID recovery. And I think that's a significant signal. 47 points is still below the neutral 50 mark, which means more businesses are dissatisfied than satisfied with current conditions. But the trend is unambiguously positive, and the pace of improvement is accelerating. Moving on to the JSE so far this year. As at the end of Q1, the JSE ALSI returned negative 0.6%. And as one may expect, the largest drop occurred over the past 6 weeks. The Resi 10, which is the blue line on the graph, managed to hold on to some of its gains after losing 16% in the last month. But by the end of the first quarter, the index provided a total return of 7.2% year to date. It's a stark reminder of how volatile these stocks can be. Our house view remains the same on resource tickers though. We are underweight versus the benchmark, but still have ample exposure given the constructive outlook on commodity prices amid rising geopolitical tensions as well as energy market tightness. You would have already noticed that the blue line has risen sharply again at the start of April, proving that investors see these drops as attractive entry points. The industrial 25, represented by the orange line, has gone in the other direction, losing just shy of 9% year to date, with a mixture of both gainers and losers. Retail stocks, together with the processed Naspers duo, have experienced the largest drop. The growth story in SA is slow moving, and the interest rate cuts will take a while to trickle through the economy, so it will take time for retailers' profits to catch up. Moving over to the FINI 15, which includes financial institutions and REITs, or real estate investment trusts, financials have continued to hold up well. But that being said, the index is still down 0.3% year to date. Looking ahead, the recent resolution or potential prolonging of the Middle East conflict will be the key determinant of our portfolio's performance. If energy prices stabilize and the oil shock proves short-lived, the Reserve Bank should be able to resume its cutting cycle, delivering the household income relief that is critical for our retail, banking, and consumer-facing holdings to re-rate. The structural case for SA equities remains well supported. Yes, the budget is credible, reform momentum is building, the GNU is holding well, and valuations are attractive. We expect the recent stretch of concentrated resource outperformance to broaden as domestic conditions improve and remain confident in the portfolio's positioning to benefit from that broadening.